Your brain just found a pattern that doesn't exist, right now, in this market. In that setup you've been watching for 3 days. You're not imagining it, that's the problem. Your brain is doing exactly what it was built to do, and it's going to cost you money. The question is, how do you stop a survival mechanism that runs faster than conscious thought? You've been watching a stock for weeks. It bounced off the same level twice, maybe 3 times, and something in your chest says, this is it. You enter with conviction, real conviction, the kind that feels indistinguishable from certainty. Then the market does what markets do. It goes somewhere you never expected. Stop gets hit, you exit, and you sit there asking the only question that matters. Why do you keep seeing things that aren't there? Nobody in a trading course will tell you this part. That feeling of certainty wasn't analysis. It was apophenia, your brain's impulsive need to find order in chaos. Faces in static, animals in clouds, support levels in noise. A researcher spent years working through tens of thousands of retail trading accounts and found that the majority of losing trades weren't random mistakes. They were patterned mistakes. The same wrong read, executed again and again with full confidence, with conviction. Because your brain doesn't just find patterns, it rewards you for finding them. Dopamine hits the moment you spot what looks like a signal, before the trade opens, before price confirms a thing. That electric snap of recognition. That feeling of, I see it. Chemically, it's identical to being right. Your brain is gambling on its own conclusions. And that's where it gets strange. The more experience you accumulate, the worse this problem can become. Experience teaches your subconscious to pattern match faster, with more confidence, sometimes with less accuracy. One doesn't cancel the other out. That's not a strategy problem, it's a neuroscience problem. And it lives inside the same mind you're trying to fix it with. So what's actually happening inside your skull when you look at a chart? Your brain has 2 systems running simultaneously. One is fast, automatic, emotional. The other is slow, deliberate, rational. Neuroscientist Joseph Ledoux spent decades mapping how fear signals travel. What he found was that the emotional brain reacts before the thinking brain even wakes up. 12 to 20 milliseconds faster, to be exact. Which means by the time you consciously think, that looks like a double bottom, your limbic system has already decided it's real, it's important, and you should act. Think about that. The pattern recognition precedes the rational evaluation. Daniel Kahneman called these 2 systems simply System 1 and System 2. System 1 is your ancient pattern engine. It kept your ancestors alive by recognizing predator shapes in grass. It is not wrong. It is just wildly misapplied to financial markets. Because a lion in the grass repeated the same behavior. It followed rules. Markets don't follow rules. Markets are partially random systems wrapped in enough structure to fool pattern-seeking minds. Mark Douglas understood this. He spent years watching traders destroy themselves, not on bad strategies, but on the belief that they could predict what an inherently uncertain system would do next. That belief, that certainty, is apophenia in its most expensive form. Your brain constructs a narrative, assigns meaning, allocates confidence, all before price has moved a single tick in your direction. Now here's where it gets interesting. You can't stop this process, but you can build a system that audits it in real time, and that changes everything. Marcus lost money for 4 years straight. Sharp guy. Read everything. Steenbarger, Tharp, the academic literature. Understood the theory cold, still bled. A performance coach, the kind Brett Steenbarger writes about, introduced him to one practice. Before every trade entry, Marcus had to score his confidence. 1 to 10. Not how good the setup looked, how confident he felt that the pattern was real. Then, after the trade closed, he scored it again. 3 months in, what he found stopped him cold. The trades where he felt most certain, 8s, 9s, 10s, carried negative expected value. The trades where he felt uncertain, the 5s and 6s, ran slightly positive. His confidence was inversely correlated with his accuracy. That's not a coincidence. That's apophenia in measurable form. When his system was firing hottest, when the pattern felt most vivid and undeniable, he was most likely in the grip of false recognition. And that's where it gets domintuosa, because this isn't a quirk of Marcus. Research across thousands of retail accounts shows the same inversion. Overconfidence correlates with overtrading. Overtrading correlates with losses. Not because these traders were unsophisticated, because their brains were doing something deeply, stubbornly human. Marcus trades differently now. Rates confidence before entry. Above 7, he waits. He asks himself one question. Is this a signal, or is this my brain finishing a story it started? Not his strategy, not his indicators. One question. That's what changed his trajectory. You're not broken for seeing patterns. You're human, precisely human, but the market doesn't grade on humanity. So here's your practice. One number, honest. If it's above 7, pause. Ask whether you're reading the market or finishing your brain's sentence. That single pause between impulse and execution is where edge lives. Not in the indicator, not in the system. In the moment you choose awareness over automation. That's the work. Quiet, unglamorous, repeated 10,000 times before it becomes instinct. You're already doing it.